And those Dolphins are going to win the Super Bowl this year, huh?
Get the out of here with that talk.
You got a squad, kid.
If the Dolphins can sell out a home game, I'd be impressed.
Dolphins sell out every home game for like decades, dude. What are you talking about? Hey guys, JC Parets here, founder of AllStarCharts.com, and I am joined by my esteemed colleague, Mr. Sean McLaughlin. Shawnee, baby, what's happening?
What is up, JC?
Listen, trying to put on a trade. We had our analyst meeting this morning. We talk about a lot of things. We're talking a lot about the dollar, interest rates, and how that's impacting some of the sector rotation. But new multi-year relative highs in healthcare. And Shawnee we brought up a few big bases, things like Merck, Eli Lilly making new highs. But the Cigna, that was the one that you really liked the best.
Well, it came down to a couple of things. Number one, a lot of those other charts, a lot of the stocks looked pretty good, but they were either thinly traded, maybe not thinly traded, but I didn't like the way the options pricing was setting up. And with Cigna, this chart in particular, I just felt like it had the better look out of all of the others. It felt like a tighter base. We're looking at a longer term base, but it's pretty clean when you zoom in like that. When you've got highlighted kind of two bases there, I think that this stock, and I'm not alone in this, but if it clears cleanly the 270 level, it's got a lot of room to run from here.
Yeah, what I like about this is the relative strength. When you look at as many charts as I do, or a lot of us do, most charts don't look like this. They look like this one upside down, right? That's what most charts look like. So when I see something like this, it definitely stands out. You talked about relative strength. How many times have I've known you for years. Have you ever used the phrase relative strength in the title of a post? This might be the first time. Is it not?
It might be the first time.
So, that just goes to show you, even Sean is like, yeah, this is what JC and the guys are always talking about. This is that, relative strength. It is, so it stands out. Now, in a bear market, what tends to happen is the opposite of sector rotation. So like in a bull market, for example, you get sector rotation. So the lagging sectors catch up to the leading sectors, and you get that sector rotation, which we always say is the lifeblood of a bull market. Now, in the case of a bear market, the opposite happens. The leaders tend to get dragged down by the laggards. And right now, healthcare is one of those leaders. We're seeing it across the board, new multi-year relative highs in healthcare as a sector relative to the overall market. And then you have these monster bases. And then even in the little guys, you're seeing some relative strength in the shorter term in biotechnology. So again, healthcare as a theme continues. So if the risk is that we're in a bear market and the rotation is they're going to hit healthcare, which is the most recent leader, like they've hit other leaders, that's the risk, which is why I like this trade, which is a bull call spread, because the risk is already predefined by what we lay out. So we're essentially limited partners in this trade. How did I do explaining that?
I think you did very well, JC. Well done. In addition to everything you said about the bull call spread, we did it because we also have earnings coming up in about 3 weeks, maybe 4 weeks here for Cigna. We've got earnings, it's August 4th, actually, it's the exact date. So that adds an element of additional risk to the trade. If you go back, I don't know if you have a daily chart. I don't think you have a daily chart queued up, but there were some earnings gap downs back in early 2022 as well as in 2021 that make us a little bit concerned that, hey, we don't want to have the rug pulled on us when earnings come out in 4 weeks. So defining our risk and limiting our risk in that way felt like the responsible thing to do. And options premiums are also a little bit elevated here. So
yeah, you're getting paid for it. So
yeah, so we're selling the out of money calls to take advantage of that as well. And hey, there's a reason why we chose the 300 strike. That wasn't an accident. That was very deliberate.
What's the trade? It's a bull call spread. What does that mean?
It means we're long the 270 call and we're short an equal amount of 300 strike calls. That's a classic bull call spread where you buy a at or slightly out of the money call and sell a further out of the money call against it to lower the cost at the trade off of limiting your upside. So as you can see in the chart there, once that graph gets above 300, we can't make any more. The most we can make in that trade is $19.50 because the most that spread could be worth is 30, right? The difference between the strikes is 300 minus 270 equals 30. That's the most that spread could be worth. We paid 1050 for it. Therefore, the most we can make in that trade, if all options expire in the money, is we'd make 1950. But when you do a bull call spread, you cap your upside gains, but you do that because you're lowering the cost of participation, which actually increases your odds of success in the trade.
So it's funny because a lot of times when you hear about options, people are like, "Oh, it's too risky. It's too risky." But if done properly, it's actually less risky. You are taking risk off the table. In some cases, you are able to minimize your risk and be able to have a larger position because you can only lose what you lay out and you can get exponentially more reward. That's one way to do it, managing risk. Another way to do it is to really just increase the probabilities of success. So you're essentially becoming the house. You're getting paid to play. I like that.
Yeah. And it's important to talk about the odds of success. I actually had an email with somebody just a little while ago about this trade, and he was pointing out that this trade only has I forget the exact number he said, but I think he said it had a 31% chance of success. And yeah, that may be true. This is not a high probability bet. Whenever you're buying calls, the odds are always against you. Where we think we have an edge here at All Star Charts is that we have an opinion on the stock, and the opinion supersedes what the options market is pricing in. So we're making the bet that the options market is not pricing in what we're seeing. And that's how opportunity is always created, right? There's always a mispricing.
Are you saying the All-Star Charts team is smarter than the options market? Is that what you're saying?
That's not what I'm saying. I'm just saying the options market, market makers, when they're pricing their options, they're not looking at technical analysis per se, at least not the way we are. They're going about various different statistical measures. But anyway,
I'm just messing.
Yeah. But anyway, to finish my thought, when you're buying calls that are out of money, of course it's a lower probability bet. But the trade-off is that when you get it right, your gains can be exponential. So that's a trade-off. There's no free lunch in trading, right? If something has a high probability of success, then your potential to make money, you're not going to make a whole lot of money because you're already almost guaranteed the win already going in. So no one's going to pay you for that.
Nice. All right, so let's go over it one more time. We're going to be buying a Cigna CI October 270 300 bull call spread for approximately 10.5. That means we're long the 270 calls, which is just slightly out of the money. Right now they're around 268, 269, and then short an equal amount of the 300 calls. What's great is that the risk is really limited to what we put up there. So I really like that a lot. I got another comment for you, Shawnee.
Okay.
What about Miami, Florida State, and Clemson moving to the SEC?
I think it makes sense for them. The way the college football landscape is shifting in a way that you and I talked previously, I'm not a fan of. But hey, the way the landscape's moving, it absolutely makes sense for them to join the SEC.
Oh, that ugly shirt of yours. It's that disgusting shirt that you should throw in the fireplace. Oh, look at that. Oh,
Go Gators.
Nobody wants to see that. Nobody wants there. Oh.
Look, if you want to be the best, you got to join the best, JC. And if Miami wants to be the best, they got to join the best conference of college football, and that's the SEC.
The SEC is the best conference. I'll give you that. I mean, I don't think there's any doubt. I mean, man, what's the ACC going to look like if Miami, FSU, and Clemson leave? Like,
it's going to look as shitty as the Pac-12 looks right now.
Right. So yeah, it's a whole thing. So all right. Well, listen, we're putting on the bull call spread. Any final words of wisdom on this trade, Sean?
Just, manage our risk. Our risk is defined, so that we'll never have to panic on the exits. But here's what I'm looking for between now and earnings. August 4th is the earnings date. If CI can't hold above 240, that's the level I'm watching. If we can't hold above 240, then I'm getting out of the trade. Now, if it survives earnings and we don't have an adverse price reaction on August 4th and the stock, either comes down just a little bit or goes up, either way is fine. Once that happens, then I'm going to tighten up my stop loss level, and 255 is the level I'll be watching for an exit after earnings if it survives earnings.
All right, rock and roll. All right, guys, at Cigna, we are buying an October 270 300 bull call spread for approximately 10.5. That means we're long the 270 calls, short an equal amount of the 300 calls. This is in October. Shawnee, always a pleasure, my friend. Thanks, guys, for being here.
Take care, everybody. We'll see you next time.